From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for August 23rd, 2024. Let's check the calendar. The Brew Crew is in Oakland this weekend, but back in town Tuesday for a 3-game set with San Francisco. Heads up, it's Mexican Fiesta at the Summerfest grounds. At the Pabst Theater, we have 2 great nights of the Fresh Jazz Coat Festival. And I'm really looking forward to this next one. Saturday at Bayshore Town Center, it's Motown and Legends of Soul Review. That'll put some dip in your hip. Who didn't know this? Former high-level officials from the CIA, the Department of Defense, and Lockheed Martin, all of them dealt with unidentified aerial phenomenon. We used to call them UFOs. They have all categorically stated that UFOs do exist. Duh. All you have to do is watch E.T. to know that's true. From outer space, we're off to Arizona. A large desert tortoise was recovered while trying to cross Interstate 10. The tortoise escaped from an ostrich ranch 3 miles away. It's Arizona, 115 degrees and no water. I'm thinking the turtle just turned himself in. And one more animal story. An alligator was spotted off the shore of Lake Erie in Pennsylvania. I'm not sure what's worse, roasting on an Arizona highway or swimming in Lake Erie. And finally, our headline of the week comes from the Minnesota Star Tribune. Minnesota woman tries to run over boyfriend en route to couples therapy session. I don't think they're going to make it. On the podcast today, we have Mike Hoelzl, Kendall Bauer, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. One more reminder not to swim in Lake Erie, I guess, is if we needed it. The market's a strong overall week. The NASDAQ up 1.4%, closing at the bell at 17,878. The S&P 500 also up 1.4%, adding 80 points this week, closing at 5635, and the Dow Jones Industrial Average up 1.3, closing at 41,175 at the bell on Friday. For the year, the NASDAQ up 19.6, including dividends, the S&P up 19, and the Dow Jones Industrial Average up 10.4%. A quick look at the week, obviously a strong overall week. Mike, maybe the place to start with the Federal Reserve. We had the much-anticipated meeting out west, Jackson Hole, and Jay Powell spoke on Friday. It's clear he has come around, as had most of the rest of the Fed, based on the release of Fed minutes, to this idea that September rate cuts are certainly in the works.
Yeah, a lot of people were calling for this a few months ago, and they were kind of signaling that September might be the one. And now it almost feels like with kind of the last jobs report that they were almost kind of backed into a corner a little bit to talk like this, right? It was, now the question is, how, is it a quarter point? Is it half a point? What are they going to do? I thought the most interesting part of Powell's speech was, and I read through it, was a word that was missing from it, which was gradual. A lot of other Fed governors had used the term gradual in terms of rate cuts. He didn't. So that makes me think that some larger ones are on the table. If you're a betting man, I saw the odds that they think between 30 and 40% that it could be a half point cut. But I think due to their kind of conservative nature, just as an overall body, I think you could see more of a quarter point to start to dip their toe in to see, again, if they're kind of going in the right direction. I think they are, but I could see them being a little more conservative with the first one and then being more aggressive down the line.
And Powell was clear that the labor market is now the kind of item of attention. It had been inflation, it feels like, for so long, and the language shifting out of the last Fed meeting, but especially here in his conversation Friday morning at Jackson Hole. The statement, "We do not seek or welcome further cooling in labor market conditions," and added later on, the cooling in labor market conditions is unmistakable. It's almost as if they now are singularly focused. A reminder, of course, that the Fed does have this dual mandate, price stability being the part we were so focused on for the better part of the last few years. But all of a sudden, a couple of weak labor reports and an update Joel, this week on kind of the full year labor numbers going back a number of months now, but it seems like the cooling labor market is the piece that's catching everybody's attention.
Yeah, Kyle, as Mike alluded to, the jobs report from for July came in weaker than expected. It was the unemployment rate, part of that was 4.3%. That's the highest unemployment that we've had in almost 3 years. And then earlier this week, and we always try to say, don't put too much in any one month's report because they update the numbers. Well, earlier this week, they updated the numbers from the 12 months that ended in March, and they said that employers added 818,000 fewer jobs than they originally counted. So, if you think that the July report was weak, and then you take, nearly 1 million more jobs out of that, it's looking less robust than we were thinking, and it is part of the Fed mandate, as you say, to keep full employment. It's still been a healthy job market. We have other indicators of that. The labor, the job opening and labor turnover survey has been strong. The unemployment insurance claims are strong historically. So there's been slowing down there, and there's some weakening, and maybe that's going to push the Fed to those cuts you're talking about.
Yeah, one of the things I thought interesting about kind of the unemployment rate that Powell talked about was he really kind of attributed the rise in unemployment to more individuals entering the workforce. And I mean, again, you're getting, like you said, the last jobs report was slower, but again, prime age workers are still on the rise. And also, as I've mentioned to clients who talked about this to me, it's going to slow down eventually. It's just math. Like, you can't do 300,000 jobs a month in perpetuity. That's just not how this works. And so with the Fed kind of keeping the rates where they were, they are now able to kind of fight this slowing of employment by lowering some rates.
Right. So the unemployment rate's going up more because people were sitting on the sidelines waiting for the opportunities, and now they're seeing them and getting in, instead of the unemployment rate going up because there are a bunch of layoffs.
I think a strong reminder that there's a lot of nuance to that data. And Kendall, maybe a reminder as well that when we look at Fed action, we don't always feel the impact of that action right away. It can take months, and a variety of reasons why it takes months. But I think it's important to remember two things. One, that it takes a while, and two, that even if we make a 50 basis point or a 0.5% cut, as opposed to that quarter point that maybe is the more likely outcome right now, we're still talking about a rate environment that's still restrictive. It's not all of a sudden accommodative just because they're cutting. It's just less restrictive than it was before. And so I think when we look at that part of it, and then the other part, maybe we're not going to feel that rate cut right away.
Yeah, I think great point. And again, I think for me, it's the takeaway is the overall direction we're heading. To your point, just because they may kick off with 25 basis points, or even if we see a 50 basis point rate cut, doesn't mean things are going to be, loosened extremely. I think my guess would be that they're likely to take a more methodical approach, kind of what Mike mentioned. I think with that comes an opportunity potentially for bonds, which is something we haven't seen, in over a decade. Right? With yields being so low coming out of the financial crisis and rates being so low, we're now to a point, too, where bond funds finally have some attractive yields. And you throw in a couple of rate cuts potentially this year or even into next year, and we could be walking into a pretty potentially favorable or attractive bond market, which bodes well for the 40% of the 60-40 or the balanced portfolio that for the last decade and a half kind of kept up with inflation. It, of course, provided you stability for the most part. But that's one thing that I'm excited about. I hear that comment, from clients every now and then. Well, why do we have bonds? They don't do a whole lot. What's their purpose? And, of course, we go through and remind them and educate them. Their main purpose being downside protection. But I think there's some optimism or some excitement there for potentially some more favorable returns on the bond front.
Yeah, and what I love is you make those comments, and at the same time, one of our favorite Wall Street Journal writers, Jason Zweig, was writing this week about how the 60/40 portfolio is dead again. Not really sure how we can write the same article over and over. When you look at the actual underlying fundamental principles, it doesn't really seem that we're in any different environment than we were. And maybe to your point, the 40% of the portfolio is probably the piece that gets to do a bit of the heavy lifting.
Yeah, and I think we should be fair to Jason Zweig. I don't know if he was the one that wrote it or if it was a different writer. But to your point, again, that was on the front page of at least the digital subscription to Wall Street Journal. And, we've seen this before. People attack this concept, and it's less, as we've talked about, it's less about that 60/40 allocation and more about the idea of balance and diversification, right? That asset allocation, that's going to be different for each and every investor, for each and every client. Everybody has different risk tolerance and time horizons and goals, but the overall idea, I don't think, is going anywhere anytime soon.
I read that article, Kendall, and it reminds me of how every so often, and this is in the entertainment industry, you get the article that Saturday Night Live is dead. Every once in a while, someone writes that, and then because they're going through a lull, and then next thing you know, Saturday Night Live is back because they have some great sketches and some great stars. It's kind of the same thing. It's going to go up and down like a lot of different, strategies you have, but it's always there. It's proven that it works. Again, Saturday Night Live has been on the air almost 50 years. It's 60/40 has proven that it works for a lot of people, and so I always kind of take those articles as a grain of salt because just give it time. It'll come back.
It will, Mike, maybe a perfect place for you talking about Warren Buffett's massive pile of cash at Berkshire Hathaway.
I mean, I like cash.
That and Buffett. It's not Jimmy Buffett, it's Warren, but
Rest in peace.
So as
Not Warren Buffett, sorry.
Yeah, yes. As you kind of look at the headlines that have been out there on Berkshire Hathaway, and I got a question this week from a client, which is, I think, very well founded, of if they're sitting on nearly $200 billion in cash right now, shouldn't I probably be doing a little bit of the same? How do you kind of navigate, those big headline names like Warren Buffett, putting that large stack of cash aside and going, well, yeah, but maybe what they're doing is a little different than what you're doing as an individual investor?
Yeah, well, most of my clients don't have $189 billion to have in cash. But it's kind of a flippant answer because I'm a flippant guy. But what I do tell him is, there's a reason that he has a lot of cash, and quite honestly, a lot of people have cash because you're getting paid for it right now. And it's one of those things we talked about before about keeping your powder dry, right? Like you had some valuations that were stretched pretty big. Now some of them come back a little bit, and the broader market is kind of rising. But you're getting a really nice yield still. And kind of going back to the first topic of the Fed interest rates, they're not going to go from 5.5 to 3 like that. It's going to take a little bit. So, yeah, he's probably had a lot of cash on the side because he's getting a nice yield. I mean, again, when you have that much cash, you probably get a higher yield than most, just guessing. But I think he's kind of picking his spots because you hearing the word recession popped up a while ago, like when the market went down. For me, it just seems like Buffett's kind of picking his spots because you're looking at housing and financial stocks are closing in on all-time highs. That seems like it's a pretty decent indicator that the end of this rally isn't anywhere close. So it seems to me like he's a smart guy. His company's smart. He's just kind of biding his time and waiting for what he wants to put into action.
I think, too, to piggyback off that into something we talk about with clients all the time is he's executing the very basic concept we all know as investors, or you should know, and if not, here's a quick lesson: buy low, sell high. Markets have been on a fantastic run the last 8 months. So some of that, I'm sure, is him taking some chips off the table, which is something that comes up in many of my client conversations is, hey, we've had a fantastic run. We're heading towards probably a little more volatile market towards the end of the year with the election. Why not take some chips off the table? If your allocation has climbed a little bit because of the rally, which we know tends to happen, reduce risk. For folks that have to take things like required distributions, that's a great use for it. For those that do things like charitable gifting for their RMDs, don't be afraid to think about setting some of those gains aside now. It can reduce risk. It can give you some peace of mind if waters get a little choppy here towards the election. So I just thought interesting, some people will say, well, I should be doing what Warren Buffett's doing. Well, you can in a way, maybe that still suits your individual goals and objectives.
And I think for most investors, they are doing precisely what Warren Buffett is doing, in that when we say there's $189 billion in cash sitting on Berkshire Hathaway's sidelines waiting to get put to work, the part that's unspoken is the $800 billion that's already invested. And that is largely in some of the biggest names that we have to offer in our country for stock investors. And so if you're already an investor, if you're 60 or 70% in stock as an investor, you're kind of already doing what Buffett's doing, because the rest of your portfolio is in that higher quality stuff that we were talking about earlier, the opportunity set in bonds. Yeah, it's not cash, and you're not going to be able to just turn around and buy $100 billion worth of Apple or Microsoft tomorrow if they're down 10%. But it's the same kind of general concept of we're trying to sell high and buy low, which is, I think, Kendall, what you're pointing out. I think the other big thing on my list right now is just the changes that keep taking place in kind of the education landscape. Kendall, we had a big update coming into the 2024 FAFSA filing season that might impact grandparents owning 529 plans for their grandkids.
Yeah, this is something that just went into effect, if I'm not mistaken, for this upcoming school year and moving forward. And it's kind of a big deal. The gist of it is that previously, distributions from a 529 plan where the grandparent was the custodian, right, for the benefit of the grandchild, were treated as untaxed student income. And with that FAFSA application, FAFSA is the student aid application that many kids apply for to pay for part of their schooling. Income distributions from a 529 held by a grandparent could reduce the child's financial aid eligibility by up to 50% of that distribution amount. So I'll give you a quick, easy example. Under the old rules, a $10,000 distribution from a 529 plan from a grandparent could reduce the grandchild's eligibility by $5,000. You have a kid that's in a Ivy League school, you can imagine how that could have a larger impact. The big change now is that grandparent-owned 529s will no longer affect financial aid student eligibility from distributions, meaning FAFSA is going to look at federal tax returns for the parent, for the child, and now distributions from 529 plans custodied by grandparents will not work against the grandchild. Grandparents can hold 529 plans. That doesn't have to be included on the FAFSA aid application, and distributions that they use to pay for the child's tuition no longer has to be included. If it is under the parent's custodialship of that plan, it does. So that's a pretty big deal. It's an incentive in some cases. And I'll give you the most common example that we'll see is a grandparent will say, hey, Johnny's getting ready for school. I think the dad should take over the plan because we're getting older and you're the parent. Why don't you manage it? Well, now that could potentially have a negative impact. So something to keep in mind. If you have questions, call your advisor, call your broker. But a notable rule change, I don't think that caught quite a bit of attention as we quickly approach fall semesters.
I think those 529 plans are such an important potential tool, but they were always kind of thrown out as the catch-all. Oh, you want to save for college, here's the 529 plan. And often we forgot the second part of that conversation as investors, which is what kind of impact is this going to have down the road? Getting some clarity on that grandparent-owned 529 plan, not having the impact it once had, but more importantly, it, I think, reminds us that we need to be clear about why we're saving the way we're saving. That if you have those 529 plans, it's probably worth revisiting what you're putting in them, why you're putting it in there, because the rules have changed drastically over the years, including the addition of using 529 plans for K through 12 education including some changing tax rules on state levels, and plenty of things to pay attention to if you have one, worth checking back in with your advisor to make sure, no, this still makes sense and the way we're doing this still makes sense.
One thing to circle back that I want to make clear, this is being referred to now as the grandparent loophole, but it's applicable to any family member that's a custodian of a 529 plan that's not the parent. So that's important. Aunts and uncles that have 529 plans for nieces and nephews, it's treated the same way now as that grandparent loophole. So any non-parent, essentially family member, that is paying or taking distributions to pay tuition for the beneficiary falls under that new category.
Yeah, I think those are critical pieces to understand, and of course critical pieces to work through as you're thinking, how do I help save for the later education of this beneficiary? Joel, a couple of other economic indicators this week worth touching on. The survey of leading economic indicators, still a number in decline, and yet maybe a little rosier than it had been.
Not declining as much. That's the main thing. It declined again in July. This is an index of a dozen or so indicators that the Conference Board uses to try to guess as to the direction of the economy. And it was in decline, but if you look at the 6-month measure, it wasn't declining as much as it was in the previous 6 months. So because of that, the Conference Board says it's no longer signaling a recession. So that's good. The Conference Board predicts that in the current quarter that the GDP is going to be growing 0.6% on an annual basis, and for the fourth quarter that it'll be 1%. So that's slow, that's below average, but it's not recession, it's still growing.
And in an environment in which the Fed is cutting rates potentially to now get back to a point where they're stimulating growth or at least letting the economy kind of move the way it's supposed to. And then some data on home sales, both existing homes and new homes, and some encouraging signs maybe on price. Sales going along pretty strong, but more importantly, maybe some signs that prices are stabilizing.
Yeah, and the National Association of Realtors come up with the existing home sales numbers, and that's the vast majority of the housing market. And they're still categorizing the market as sluggish. But their sales went up in July for the first time in 5 months. New home sales, which the government tracks, a much smaller number, but that was up the second month in a row, and it's above the level it was just entering the COVID pandemic.
Yeah, I think we keep such a close eye on that economic data because it is, as we mentioned kind of at the top of the show, the thing the Fed is most concerned about now. What does it mean for employment? What does it mean for kind of the broader economic picture? And so far, we have talked for months, it feels like, an economy that's slowing, but not to the point of maybe the panic that might be being written about in certain places, might be being talked about. And so definitely warrants further kind of consideration, close eye, but I'm not overly concerned at this point that the Fed's waited too long. Those rate cuts in September, I think, will be helpful, or rate cut at least, if it's not cuts, will be helpful to kind of get some clearer indication of maybe how much stimulus is still needed for the economy. The only other thing worth mentioning is that our listeners, those that are clients, probably have invitations in their mailbox this afternoon if they haven't received them already. Certainly in the next couple of days for the annual client seminar we'll be putting on again this year, October 1st and October 9th. It is going to be held at the Ingleside Hotel and Conference Center out in Waukesha, and so very much looking forward to putting that on. If you want to get your name down on the list, I encourage you to give us a call, shoot us an email. The instructions are right on that invitation you got in the mail. If you are not a client and you're interested in attending, we always welcome anybody that might want to hear more about kind of what we think is going on in the world, how we think things are shifting. And so feel free to reach out to us, and we are happy to get your name added to the list. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.